We get to hear about charitable planning one more time. I know we've covered it a little bit already today, so this should be a little bit of a refresher and not too much new information in the sense that some of this you've definitely heard already, okay? So I liked how this Tyler took the approach of helping clients spread the holiday cheer. And the reality is it's been an interesting time, and ultimately the market conditions are such that in general charitable giving fell when adjusted for inflation. So it's only the fourth time such a decline has happened. I think we attribute that to perhaps some challenging economic certainties, or really ultimately people kind of wondering about the uncertainty of the market and things like that. But it's one of my favorite aspects of the estate planning, because it really is fun to be able to sit down and look at what's going on with the client's charitable inclination. Current tax deductions. So you're looking at standard deductions versus itemized deductions, and the Tax Cuts and Jobs Act of 2017 reduced statutory tax rates. And so almost all income levels of taxable income shifted the thresholds, and the standard deduction also changed in 2024 to 29,200. We talked already about the Secure Act changing quite a bit, with distributions made to the beneficiaries on the 10th anniversary. Now, we do know that some of the Tax Jobs Act of 2017, it has a sunset provision. So we're looking at that unified credit changing and cutting half in January 2026. So you've heard this throughout today, so we know none of that should be new. But how that impacts charitable trust, and really talking to your clients about charitable trust, in general, people want to know more about this. And so I think they're just not getting that information from their advisor. And we're not sure of the disconnect. I think as experts in our field, we tend to maybe assume they might know it or not know, again, whether it's the primary motivator for the client. So this is really about counseling, listening to the client, understanding their goals and objectives. And ask, kind of those, I like the idea to ask these open-ended questions to really understand and listen for clues to see if they're passionate about any of the causes they've supported. So assuming they have a charitable inclination, it's really about choosing the right charitable trust for your client. And we already know, because you've heard about this in some of the prior topics I've covered, that there are several types of charitable trusts. And each type is an irrevocable trust, so we always start with that. It could be grantor or non-grantor, as we learned earlier. But general two characterizations is a charitable lead trust or a charitable remainder trust. And the charitable lead trust and remainder trust have a nice added benefit aside from the income taxes. They do avoid federal estate taxes by removing that corpus, that principal, that asset from the taxable estate for estate tax purposes. The goal oftentimes in discussing this with your clients is to reduce the income taxes and allow the grantor, the trust maker, to provide for charitable organizations. So you're kind of hitting a lot of key goals there with this type of planning. And the clients need the income generated by the asset because, again, I mentioned my example earlier, they have this great apartment building, they're just tired of managing it. So they want to sell it, but they're used to that income and rely on it. Then a CRT, the charitable remainder trust, makes the most sense, goes with all income during their life, with the remainder going to the charity at death. And either one, when you're looking at drafting that, you're looking at how long do they receive that income, which could be for that beneficiary's lifetime. And again, it could be for the grantor's lifetime, or I had a client recently set up one for his daughter's lifetime, or you could set it for a term of years. You'll also want to check on whether it is a grantor or non-grantor trust and decide which one makes the most sense for the client, whether the trust will pay the income at the trust rate versus the grantor paying that at the grantor trust rate. So it could, be either. And it also, a charitable lead trust can be either drafted as a complex trust, as opposed to a simple trust. A simple trust requires net income to come out, whereas a complex trust does not. And the attorney and like the drafter must also determine in the terms of the trust how the income pays out to the charity. So a charitable remainder annuity trust has that annual annuity. It's a charitable remainder trust. So we know that the beneficiary, the non-charity, receives the income. And the annual annuity amount is fixed in a charitable remainder annuity trust. So it does not change unless, of course, the principal's gone. It's just kind of a standard charitable remainder trust. The unit trust is a fixed percentage of the value of the trust assets at the beginning of the year. So it's recalculated or recalibrated each year to determine what that unit trust amount will be. And it must be at least 5%, but it's 5% of what? That's fixed each year on the value of the trust assets. And these are also additional revenue codes that mandate the remainder amount, as I mentioned earlier, there can be no less than 10%. So you have to run these numbers when you're looking at how much is going in, what percentage are you fixing it at, and will that be enough to ensure that there's at least a 10% remainder going to the charity. So charitable remainder trusts are a great option to have that income generated again through the grantor's lifetime. Okay, so the charitable remainder trust, especially again, the charitable remainder trust allows them to retain the income, whereas something like, again, a charitable lead trust, which contrasts to the idea that the charity would receive the income, the remainder would go back to the family, is completely different than a donor advised fund, but it does have, obviously, a donor advised fund has a great charitable component. And I really like donor advised funds. In fact, I think it's really one of the neatest tools to be able to mimic or look a lot like what a family foundation would look like, but without the cost of a family foundation. And since donor advised funds have really been something that came into play and was an option for clients, I've used them probably quite a bit more than a family foundation because they're just so easy to administer. A family foundation brings all the administrative burdens and a few benefits we can talk about if we have time that a donor advised fund has. But something that I think the author of these materials wanted to point out is, this is a great tool, and sometimes people don't think of it. And you get an immediate tax write-off. So similar to a family foundation, if I put $1 million into a family foundation, I get that immediate deduction, irrespective of when the money is spent. So let's say I have, I think we talked earlier about the appreciated NVIDIA stock, right? So I have this NVIDIA stock that if I sell, I'm going to just pay a huge capital gains. And so I can do a charitable remainder trust to generate the deduction and offset that gain and still have the income. But if I really don't need that income, or perhaps some of it of the stock I want to put it into a charitable remainder trust, and some of it I just want to put away for charity, okay? And I don't want a lot of administrative burden associated with this. So a donor advised fund would be a great option in this scenario. The donor would, these are typically set up either through a local community foundation. We have the Pasadena Community Foundation here in Pasadena. We have the California Community Foundation. They all have donor advised fund, where I always say, okay, well, these large foundations, you're almost borrowing their infrastructure to create a fund within their fund that you can able to sign a letter of intent to be able to say what you want these funds to be used. Appoint an advisory committee. This is a really neat thing to start to get the kids involved in distributions and a successor advisory committee if you're not here. And then each year, well, that NVIDIA stock, let's say, is sold, the proceeds sit there. Each year you can decide how much you want to dole out to a charity. So it's really, really cool. Then again, it very mimics a charitable organization, similar charitable organization like a foundation. Now, some people like a foundation still, and the foundation ultimately, I guess the foundation is important because at the end of the day, you can take, I think what pushes people over to do a foundation is the idea of it, okay? So sometimes they just really like the idea of it. The other thing is that the kids do get it can take a small salary depending on the size of the foundation. They can take a small salary and they can go ahead and say, oh, well, I'm working for the family foundation, and the really large ones. We do have some large ones that we administer here at my firm. They, that is their job to run the family foundation. But you put $1 million or $2 million into a family foundation, you can't take, a huge salary from that. And that's something no one's going to retire off of that. But, some clients like that, and some clients like the idea of it. But with a family foundation, as opposed to a donor advised fund, you are essentially speaking to, answerable to the Franchise Tax Board, right? You have the IRS, and then you have the Attorney General's office to make sure you're compliant with all the rules related to that. So anyway, the donor advised fund is a great, again, option instead of a family foundation. Again, as opposed to the charitable remainder annuity trust, where again, you're getting the monthly or annual payouts or bi-monthly, however you set it up, you've in a donor advised fund went ahead and essentially just gifted that charity, made a charitable request. It's not your money anymore. It's outside of your taxable estate, which is great. You get that charitable deduction, but ultimately you're not going to get any lifetime beneficial interest. There's a question here on CRTS. Does the rule of no less than 10% of the initial fair market value go to the charity apply to the lifetime of the trust? So no. So it's at the time we report the gift and we make the gift and take the charitable deduction. It just has to pass muster at that time, because at some point, yes, it could be totally eaten up, and that is the reality, but it needs to initially pass that test when you set it up. Because you're right, you could have these 20-plus-year-old CRTs that have definitely fallen below that. It's at the time of, and gift tax returns are required. At the termination of the CLT, no, not at the termination. The other thing that in some of the scenarios the client likes about the charitable trust is that they can be the trustee. Again, I mentioned earlier in my discussion that I really don't like the irrevocable trusts for gifting purposes like the IJIT to have the grantor serve as trustee or even the grantor's spouse. I think there's too many incidences of ownership in that case. There's too much control, and you really start I think inviting the IRS's argument that this can be pulled back into your estate. But with a charitable trust, it's really just not a concern. And so oftentimes they like to be the trustee, and they do need to file the tax returns, the income tax returns, the initial return, and make sure that that's been done. So sometimes it's great to hire someone to do that and not have to deal with yourself and just pay the fee, but sometimes the client likes to generate some control over that. And then the other thing that we sometimes do is create the donor advised fund to be the ultimate recipient of the charitable trust. So it allows us to sort of kick the can down the road and say, okay, let's set up this donor advised fund and ultimately have that be the charity that the remainder goes to at the end of the day. So I think that's a really nice way to then kind of, again, kick the can down the road and say, okay, I'm going to create the donor advised fund, start to develop a letter of intent that it can change over time. And the other thing about a donor advised fund is nice if we need modifications, the client doesn't really need an attorney for that, right? The donor advised fund is just a fund managed at, again, a community foundation, or things like Fidelity, Schwab have their charitable remainder, their donor advised funds. And so you don't need an attorney to do that. Other things to keep in mind that we discussed already, let's see, in the terms of the charitable trust. Let's see. Let's see what else. If you have any other questions. It was a short one. I guess one of the ones we didn't talk about, wasn't in Tyler's short slides here, not a lot of material, but the flip CRT. So basically, I like this one and I think I talked about this earlier, when you can go with the flip CRT is where essentially you can go from one type of charitable trust to another. So the flip charitable remainder trust allows for the creation of net income to charitable remainder trust that converts to just a percentage later on. And so in a case where the client contributed like his business to the trust that we knew was going to sell. So let me give you the one client example where we did like almost every different kind of trust there was. So client had a card evaluation of his battery energy business at $6 a share, let's say. So we did a lot of planning when the value at a very low value, and then he sold his shares for close to $24, it's almost $30 a share. So great planning. And so it wasn't just, this was a $60 million transaction. So it wasn't just one type of trust we did. We did the NING we talked about earlier. We did the Nevada Incomplete Non-Grantor Trust while it was still allowed, got the tax opinion, that worked great, no California income tax on the sale. Now we're looking to unwind it. The downside of the NING was he avoided the income tax, but those proceeds are still includable in his taxable estate. It's an incomplete gift, right? The other thing that was the other type of trust that we did in that scenario was a intentionally defective grantor trust with spousal access provisions. So my client was married. He was able to gift. So he used part of his exclusion to gift some of the shares into a trust that was intentionally defective for income tax purposes. His spouse has lifetime access, so he doesn't feel like he's giving everything away to their kids quite yet. But it was a completed gift for estate tax purposes. No income tax benefit to that one, just more of an estate tax benefit. Then we did a charitable remainder trust, but with the flip provisions. So essentially, the change from a net income unit trust to a straight unit trust had to be triggered by either a specific date or a single event, which in this case was a sale of his business. Because the business went in there and wasn't really generating the income that it would all of a sudden get recognized upon a sale, we weren't going to be able to make the unit trust payment amounts, right? So he wasn't earning interest on that. Wasn't invested in bonds, let's say. So that triggered by the sale. And it can't be a discretionary event, nothing like that open up for interpretation. The change from a net income unit trust to a straight unit trust has to occur at the beginning of the taxable year that follows that triggering event. So the timing is important. So if the triggering event occurred on July 1st of 2020, the conversion of the unit trust to a straight unit trust had to occur on January 1st of 2021, right? And then following that conversion, in the case of the net income unit trust with like the makeup provisions, the unit trust governing instrument had to provide, so the trust had to provide the make amount not paid as of that conversion date, that is forfeited. So he couldn't make up these payments at a period of time. But I thought that was really helpful because, again, it wouldn't have worked if he had put that asset in there because it wasn't generating income to meet the unit trust amount. No, I thought that was a neat way of, sale of some sort of, again, unmarketable asset. So I think the use of a flip unit trust is really the most obvious way in which, a gift of an illiquid asset or unmarketable asset like a real estate or this closely held stock made a lot of sense. The use of that flip unit trust and triggering that defined event as a sale of that unmarketable event avoids the problem associated with the net income of the unit trust and allowing the assets of the unit trust to be invested for, again, a total return following the sale of the unmarketable asset. And this is the same client who said, now all of a sudden I'm getting all this income and I have to pay tax on it. And I said, yes, you do, or you could turn around and put it into your donor advised fund that we set up. And he goes, okay, that's great. But again, he figured out a way to spend it on his remodel of his home in Lake Como. So it was all fine. Everything was good. So then that flip unit trust enabled that initial problem of if a flip unit trust is used, like in that scenario, the trust assets can be invested for growth following the sale, and not only the charitable, not only if the charitable remainderment, but also the non-charitable beneficiaries of the trust kind of are happy in that regard. So you can look at the total growth versus just trying to get income, and everyone kind of wins in that scenario. The other thing that I thought was interesting with this scenario, or the example I gave you with the flip unit trust, is I thought it was a nice way to catch up for a small business owner who really didn't save for retirement, right? So at the end of the day, you could do the sale event, or we could have triggered something like an age 65. A lot of business owners really don't have time to plan for, they don't want to set up a 401k, because that means they have to pay it for all of their clients, and then ultimately, or I guess all of their employees. So they don't really have great retirement. So we could have set it up for him to receive it at age 65, or to flip at age 65. That'd be the triggering event. And so before that period of time, or that triggering event, the unit trust would be invested for growth, right? As opposed and total return, and the donor would receive the actual income earned under that remainder unit trust, under that net income limitation. And then when it converted, upon the conversion of that flip unit trust to a straight charitable remainder trust, they receive that straight percentage, right? It's just that value of the trust assets revalued each year, whether it's growing really or not. So that their retirement objectives met without really having to alter the investment strategy too much. So I think it was a good result. And then we talked a little bit about charitable remainder trust in context of kind of a strategy, or I guess approach to address the Secure Act, and the fact that the kids are going to get nailed with income tax burden on having to pull the money out in 10 years, pay the tax on it, versus again creating perhaps a testamentary charitable remainder trust under the terms of the revocable trust that's created with and funded with the retirement accounts upon passing. Yes, the remainder goes to charity, but you get a nice lifetime income for the kids spread out over a much longer period of time than you would over the 10-year rules. What else? Another kind of cool way, if it's I'm working on one charitable planning right now, where it's just a very large building, and we're structuring it to create several charitable remainder trusts with various lifetime beneficiaries. So a portion of that real estate's going to go into the charitable remainder trust for the grantors, for the trust makers, my clients, and a portion will go into 2 other charitable remainder trusts for their kids. And they're very charitably inclined, so I can look out of my office window and actually see a building down the street for the Salvation Army that they donated. But they were able to meet, their kids have not nearly been as successful as they have, and they're very much worried about them getting this money and just spending it. So this was kind of a way that they felt they sort of locked up to create lifetime income for the kids, with still giving them a nice source of income, but the corpus and principal eventually going to fund their favorite charity, the Salvation Army. So it's great. We still have a few more minutes, so if there's any questions, I might start to review some of the other types of trust. Okay, here's a question that came up. Okay, when faced with requests for distributions from charitable beneficiaries, how should trustees evaluate and prioritize these requests? What legal principles or guidelines should guide a trustee in making equitable decisions? Great question. Obviously, the answer is going to depend a little bit on what are the charity's rights. And ultimately, the charity, because it's kind of unique because in certain types of charitable remainder trusts, you can change the beneficiaries. There isn't really the same notice requirements for them to look at, well, are you investing for growth of the corpus or principal, or trying to invest just on income and get the most income? So it kind of, they have a lot less rights under that. But we've had to modify a few cases where, let me give you a good example. A marital trust was funded upon first spouse's death with a ton of speculative investments, a lot of private equity funds and things that at some point, if they were sold, would generate a ton of wealth and and they're very, very valuable now. Let's just use a number of those. They're worth $20 million now, but they're liquid. They don't generate income for the surviving spouse. They don't do anything. So we are actually just finally kind of reached almost like a settlement agreement, because the remainder beneficiaries of that marital trust are charities. And so the trustee is figuring out, well, okay, the spouse can't get any of this money. It's illiquid assets. They can't get any of the net income. There is no net income that's, required. And so we needed, to have the ability to have more flexibility. And went to court to modify that ability, and had a really, really, tough time dealing with the Attorney General's office, who was really arguing, well, kind of to the story, says tough luck. So a lot of times, if there's kind of a question of, well, what should be the trustee doing, and we think that it impacts the residual rights of a beneficiary like a charity, we petition the court. Another approach would obviously be to, if you're prioritizing this question and a charity makes a request and you're not sure if it complies, you can issue a notice of proposed action. That starts to get into a lot of trust administration, but, we recently decided, instead of the charity just, they're entitled to accounting, so we go to court and we file the accountings. We're deciding whether we wanted to process a sale of an asset inside of this trust that may or may not benefit, I suppose, probably more benefits the lifetime beneficiary. We decided, rather than, eventually they'll see it in the accounting, but prior to making that sale and the trustee had authority to do that, we decided to do a NOPA, notice of proposed action, which under the California probate code section gives them X number of days to object to it. If it objects at some point and they don't agree, then we may need to go to court. But the idea was to say, okay, we're going to do it. Any objections, and then silence is consent. So that's sort of how we handled trying to balance the two interests, the lifetime beneficiary versus the charitable remainder in this case. But I used to work for our large corporate trustee, and we would get really angry calls from the income beneficiaries who wanted all of the assets to be invested in really income generating assets, versus the remainder beneficiaries who was like, you need to prioritize growth. And what was nice about working for a corporate trustee, there's pros and cons, but is that, the statements are going out on a quarterly basis. So that's the accounting. The beneficiaries can see what things are invested in. And the corporate trustee I worked for was Wells Fargo. So they had their very formulaic type of investments. So it really wasn't a ton of deviation from that. And so it's sort of just managing the relationship between the two and say, okay, this is how, the formula we've invested in. We would have a meeting with the investment advisors, and they would explain, okay, this is a balanced portfolio. The other thing that I do like to advise my trustees on at the initial, letter, when I send them, okay, here's all the things we need to do. One of the most important things is to look at the investments with a licensed, financial advisor who puts together a good, solid financial plan. And that investment plan is not necessarily disseminated to all of the beneficiaries, but it's placed in the file. And I've developed kind of, a checklist of things that I'd like them to go through. A trustee would go through with that investment advisor to make sure they're just, covering their their basis is based on, a reasonable, prudent investment standard, because that's really what it is. And see if I can actually bring up that checklist. It's a really helpful one, actually, if anyone wants to reach out to me on getting that. And sometimes the financial advisor pushes back and they're going, well, I don't want to spend time doing this, but then you need to work with a different one, because as trustee, you need, and the market's really volatile right now. It's easy in a situation where things are going to be distributed, that you liquidate, you got the step up in basis, and you put it in some, some municipal, bond munis and T-bills right now, right? Generating 5 or 6% income till you're ready to distribute. But if it's these long-term trusts where you're balancing the growth and appreciation, the need for net income, they really need to be working with the professionals on that. So great question. It's where the idea of whether when someone asks you to be a trustee, whether you decide to say yes or no. So anyway, the other thing I would say, a great takeaway, and I didn't get to hear all of the sections that you guys covered, but most of them, and I think a common theme amongst all of these, because really a lot of these structures or trusts are at some point either irrevocable from the outset or going to be irrevocable at some point, is again balancing that need for flexibility and start really, we have an internal office debate here on the use of trust protectors, which ironically in charitable trusts are really untested. And so we've kind of decided it's not a good idea to insert a trust protector in a charitable trust, even though it's irrevocable and it would be really nice to have those flexibility. We just haven't seen it play out quite yet. Maybe we'll look at it again now that California has codified a statute that covers trust protectors, and maybe we'll take it a different approach. But otherwise, they're in every irrevocable trustee draft. Versus though, and comparing that to a special trustee, which really could do everything a trust protector does, except pretty close. Everything a trust protector does, except perhaps, I believe, we have to double check this, remove and replace a trustee, unless it's with an independent third party. I think that's the restriction on a special trustee. If they can remove and replace, it needs to be with another trustee that's not, is independent, not subordinate to the grantor beneficiary. So, but essentially they're pretty much the same thing. And the issue with either is, well, who are you going to name in the role of trust protector or trust advisor / special trustee? And you can kind of punt it down the road. A lot of my clients will say, well, whoever's, one of the provisions I like to allow flexibility is, okay, whoever is filing the return, our personal income tax returns or the return for the trust, that CPA can appoint a special independent trustee or a trust protector in the future if we're not ready to appoint it now. We decided to form a LLC that is comprised of myself and my other equity partners to actually serve as trust protector, because we weren't sure what the liability was, and I'm sure there still is, despite an LLC or no LLC. But it allowed for continuity if the one partner passes away or retires, that it would be a rotating of any equity partners in the firm serving as members of this trust protector LLC, trust protector partners LLC that we started. But anyway, I think the theme of this one of the key takeaways from today would be, how do you build in that flexibility in these trusts? We as planners really, we deal a future hand. So at the end of the day, we're setting up these trusts that can continue on for multiple generations. And we only know the circumstances as it exists now. I'm sure someone's going to pick up, any number of my trusts in 50 years and go, well, what was Vanessa thinking, right? So building that flexibility, I think, is really important. What else would I like to take a look? And then last but not least, I would say we're going into, I'm kind of internally preparing for a very busy time with the tax reduction through trusts and the state tax law changing. And we talked about the current state of the federal taxes and how to, set up these gifting type trusts and intentionally defective grantor trusts, it is going to be very busy. And I think internally, we've kind of started to think about when would be our cutoff to start helping with these advanced plans. And I'm thinking first quarter of next year. Beyond that, I just don't think, all these plans take time. And one of the key parts of the plan is always the valuation. You can, if you don't know the value of the assets, you can't really calculate how much of it you want to gift. So there are clauses, and they're called you can use a Wonderies clause where it hinges on the valuation, but those are, again, something you have to very carefully draft, and important to kind of just take a look at if you're going to be doing any of the spend planning, and kind of think about your practice management and at what point you'd want to, stop taking on new clients you haven't already started to work with to create these flats or idiots, spousal access trusts, or the idiots, or any sort of irrevocable gifting trust that you're going to use to facilitate these transfers and use of the lifetime exemption. So kind of bear that in mind, because again, I think it's going to be very busy, and the valuation experts already are a little bit slow, just because it's they're busy. And so I think if you have a client base you want to reach out to now, to let them know this is what they should be looking at, because I think it is going to be a big mad rush. It was when Biden first was elected, and it will be, I think, irrespective of what happens in the election, I think it will be headed towards the next, the sunset provision in end of 2025. So we do have a couple minutes left, so. Minutes. If there are any questions, I'm happy to answer any questions. California probate code section. So you, sorry, I wasn't gonna cover that, but let me see if I can find the citation for you right now. But you can, it is brand new in the probate code, California probate code. And I'll see if I can find that citation for you now, but I may not. It's brand new. And it gave me great, here we go, let's see here. Okay, so it adds to, so California adopts a modified version of the Uniform Directed Trust Act, which includes trust protector. It modifies, begins in probate code section 16600, and I think 16602 would be, talks about kind of a power of a trust director or trust protector. They call it trust director in that. But check it out in 16602. Okay. All right. Great questions, and hope you guys learned a lot. And you have Tyler's information, but hopefully they can circulate mine as well too. If you have any follow-up questions, I'm happy to. And Cassandra, I'll turn it back over to you.